So I'm Joe Munoz. I'm with LaSalle Investment Management in Chicago, and I'm the Chief Investment Officer of our Value Add Fund, which we call the Income and Growth Funds. And as Frank Shikram said, I guess what makes me qualified to talk about the U.S. market is that we've been investing across the traditional four property types for a long time now. And what makes me qualified to talk to Germans about the U.S. market, my wife is Bavarian, so maybe that helps a little bit. Maybe that got me the slot after the break. So a lot of this has been covered in prior segments of the conference. So I think that the best use of my time with you is to speak about the prevailing investment themes in the office sector. And in my mind, that means choices for investors in gateway versus non-gateway, and then urban versus suburban locations within those markets. And then for existing assets, you have the issue of heightened tenant expectations. Tenants like nice things in this portion of the cycle in the US, so landlords need to be ready to invest CapEx. And then the question, of course, is what to do with co-working, what to do with WeWork, Industrious, et cetera, from the landlord perspective. So on this slide, this is NCREIF Property Index, and this is the continuation of 6 T's, right? So you're going to continue to hear from investment managers about moving office investment into some of these secondary markets for a variety of reasons. This is dollar weighted, right? So bigger markets, bigger assets, bigger dollars per square foot are naturally going to have more weighted to the major markets. And from a core perspective in the US, you have this whole plethora of Odyssey funds who are measured on a relative basis relative to the index. So you'll continue to see each of these funds investing incrementally in different parts of overweighting to the index in certain sections and others. But if you're trying to beat the index, you need to stay pretty darn close to the index. And so while there's a lot of core capital in these major markets, we think that there's some capital value upside in the long term as those buyers shift more and more capital to the secondary markets as their portfolios grow. The reasons for shifting into these markets, and you'll hear Denver, Austin, Phoenix, Philadelphia, Pittsburgh, is largely a cost and quality of life story, right? We like to think of this very simply. If you're trying to hire 3,000 people in San Francisco, the median home value in San Francisco is $1.3 million. And if you can no longer put down 5% down in those cities, you need to put 20% down. And you've got tax reform that says that you're capped out on mortgage interest deduction after $750,000. There is some incentive for people to move to these different cities. Now, the movement in these cities are for different reasons. I mean, when you talk about the tech sector, not all tech jobs are the same. So the movement to in Austin or Atlanta or places like that is a different rationale than moving to a place like Salt Lake City, which is a different kind of job structure. So you'll continue to see this. We continue to advocate for long-term portfolios that the persistence of cash flow and capital value should be in the urban markets, but it should not surprise you if you hear in the next coming years more and more talk about these secondary cities for the variety of reasons that have been espoused earlier in the conference. Supply is not an issue in the office sector for a number of reasons. When people talk about supply response in the US, they usually talk about industrial and multifamily. The reason it's not an issue in our view in the office sector is a couple of reasons. Number one, given the increase in construction costs, you really haven't gotten to replacement cost rents in many markets, and therefore it's been difficult to finance even with well pre-leased projects across the US. The other part of it is the highest and best use for some of these sites in this cycle has turned out to be multifamily. So a lot of the construction that would have gone to the office sector in prior cycles have been in the multifamily space because the rents in multifamily have more than justified the construction. I would point out a couple things here as a positive for the office space. One, at just above 1% or 1.5% of supply as a percentage of inventory, that's a very healthy backdrop for US landlords. The other thing is, even with periods of excess supply, buildings that were built in 2000 and 2005, 6, 7, those are effectively functionally obsolete for today's market. So you have this period of underproduction in the office space, and you have a whole segment of the stock that is really irrelevant from the tenant decision in leasing today. So if you can deliver modern space to the US market right now, it's a very healthy backdrop. Much is made about tech. I'd make a couple points on this slide. We get a lot of interest from tenants that are healthcare tenants, but working on the online platform for those healthcare companies. Interest from retail companies that are working through connecting with customers in a retail way. The point of that is, I don't really know what's a tech company and what's not a tech company anymore, so I fully support the fact that tech is prevalent everywhere else, but everything has technology into it. That means a couple things. When you think about diversity of industry within tenant segments, I would encourage you to think about these different sectors which are more broad-based in the US, and therefore there's healthy fundamentals for non-technology-based metros, because tech is everywhere, but also it's a healthy backdrop for finance, law, et cetera, and many metros if the supply and demand characteristics make sense. Tenant expectations. So tenants in this market want really nice space. At full employment and you're trying to hire to compete away from all these different companies, you have to present your headquarters space that resonates with the corporate image that you want to deliver. So that means that as we think about touring tenants through our properties, we see a lot of renovated space that is almost an island within an older building. It's all about the art of the tour for us. I mean, if you are that company that you're trying to lure, and they're walking a prospective interviewee for a job at their company, from the moment you walk in the door, you want to show them that you've got renovated lobby space, renovated elevators, renovated elevator corridors, the fitness amenities, and ultimately the finished space you see on the bottom right to show that you're a forward-looking company, and this is what it means to work at this company. In many ways, again, to the tech argument, in our mind, there's very little difference between the build-out that tech tenants want these days and what tenants in all other industries mean. So from a build-out perspective, it really doesn't matter if it's tech or not, they're looking for the same space. So this is what it looks like for the landlord bottom line. I mean, this is trailing 3-year data, CapEx as a percentage of NOI. So this just means if you're gonna play in the US office space, be prudent in your underwriting for CapEx as a percentage of NOI, but also feel confident that if you invest the NOI in the right way, you'll get the right tenants and you'll get persistent cash flow. A lot of the mistakes we see landlords make in the US market is to say, we're gonna renovate the lobby, but not this or that, just to maintain some efficiency of cash flow. Once you need to commit, in our view, in the office space to win the tenancy, but it's gonna require a lot of CapEx, and you should be prepared to do that. From a market selection perspective, there's the suburban versus urban conundrum, and this shows the spread in cap rates between the urban segment and the suburban segment. Right now, it shows that to be about 100 basis points in cap rate spread, which is always shocking to us because I think that vastly underestimates the market psychology in terms of the lack of favor for suburban office product. Suburban office is really only second to big box retail in terms of what's been unloved in this cycle. And in many ways, that could create opportunity from a pricing standpoint, but the fundamentals continue to be challenged for a couple of reasons. Number one, it's still about recruiting. So we still see a fundamental shift into downtowns for people to recruit the people that they want. If you're going to play in the suburban, I would say make sure of a couple things. Number one, I would suggest that you buy a already leased property as opposed to trying to get great amounts of net absorption. That's a way to say buy in-place cash flow at a higher yield and use appropriate leverage to do that. And then not all suburbs are the same. So be very careful about the metros you choose. Acquiring in the 680 corridor of San Francisco or within the Route 128 corridor in Boston, those suburbs are much different than your average metro across the US. So still, we think you'll see a tilt towards urban, but as the demographics get older in the US, both the millennials and the boomers, there is some credence to being in the suburban locations in some spots. Highly amenitized areas with good transit, with shorter commutes, with good access to the preferred residential areas could be a theme to capitalize on in terms of office investment. So don't throw out all suburbs together in one category. And then finally, WeWork. I think co-working is generally a bad deal for landlords. I think about this from a real estate perspective, and the valuation of WeWork today is effectively a 2 cap. Okay, so that suggests a tremendous amount of growth. But if you were to see an LOI from WeWork or some of the different coworker spaces, just to summarize for you, it would say, give us $200 per square foot in build-out for build-out that you'll never use again. We won't give you any credit on the lease. And by the way, we're gonna try and cannibalize your small tenant activity at your building. So we look at that and we say, thanks but no thanks, generally. I think WeWork has a view that they are like the old retail anchor tenant from times of old, which is to say, if you get us, you could lease off of our momentum and change your rent roll. And if that's the case, if you've got a small percentage of NOI that you want to allocate to a co-working space, and you believe it'll change the profile of your building and give you access in terms of image of your building, then it's worthwhile. But if you're doing a purely economic deal just on a WeWork or industrial space, we would advocate that you wouldn't make that a large portion of your NOI, just for reasons that it is co-working, it is non-credit, and then in different parts of the cycle, you might not get what you bargained for there. So the important thing here, I think, is that it's changed the way that people think about office space, right? So on the left-hand side, it wasn't so long ago that we all worked in spaces like this, where you had private offices, no interaction. And then it's gone all the way to the other end, where the density is 150 to 200 square foot per person. I don't know if you've been in one of these spaces recently on the far right-hand side, but for all the collaboration that people thought would happen there, these are the quietest spaces you'll see in the office space. Everybody has headphones on, nobody wants to talk to each other, and I don't know about your coworkers, but my coworkers can be a little bit annoying in terms of their chatter in the office space. So that's just to say that be mindful of this build-out. This changes much faster than the length of the lease. Be prepared to reinvest. Pay attention to architects and space planners and tenants talking about how they use the space. You know, sensors of how people are going to be using the space, how much time they spend, where the productivity comes from. We think there's probably an overcorrection in terms of density here. You know, there are introverts and extroverts in the office space. They need to work in a different way. There's going to be some correction there. So just be mindful of the persistence of the value of your office build out when you underwrite. Be prepared to do that when you invest. But if you do that in the right way, the office space is still very beneficial. You get access to great credit in the US, long-term leases with good inflation protection in some cases, but be prepared to invest in the office space. So really, I'd leave you with that. Gateway versus non-gateway, be prepared to hear more about non-gateway for good reasons. Urban versus suburban, continue to look more at urban versus suburban, but be open-minded to some specific opportunities in the suburban space. And then just be very mindful about CapEx investment in the office space. You gotta be flexible in terms of what the tenants want, and have some confidence in this current market that if you deliver the space that you want, you can get net absorption with good credit behind it. So don't be timid about going halfway on your office renovation. Make sure you do it correctly for some staying power.